Good day, doctor. My name is Amos Jonathan Kumar and my metric number is 264825. So I'll be representing my group, which is Group 5, and we consist of 5 of our members, and we'll be focusing on topic 5, which is the special types of documentary credits. Revocable documentary credit. A revocable letter of credit, also known as a documentary credit, is a type of letter of credit of which an issuing bank is initiating and can amend the terms of the letter of credit or cancel the letter of credit completely without giving any prior notice to the beneficiary. As per the name of the documentary credit has been stated, which is revocable, which means that can be removed or can be cancelled, the name it's pretty self-explanatory for this situation. So these are some of the reasons due to which a bank revolves or revokes a letter of credit. So as we can see, there are many reasons due to this, which is when the bank decides to revoke the letter of credit is firstly because there may be any adverse circumstances such as political tension, deteriorated market conditions, and anything that is due to the bank's incapable way of to honor a term of the letter of credit. Secondly, there is a possibility that the issuing bank doesn't have any sufficient fund to keep or to honor the letter of credit, which is the agreement, which case it cancels the letter of credit, hence proving the word of revocable. Now these are some of the additional information about a revocable letter of credit, and this case of scenario is considered a rare situation for a revocable letter of credit to occur. This is because of two main reasons. Firstly is the vulnerability or the risk of non-payment. In fact, it negates the purpose of a letter of credit. Additionally, no bank will confirm a revocable letter of credit. Thus, a seller insists that an issuing bank issues an irrevocable letter of credit. Non-revocable documentary credit. The non-revocable documentary credit is also self-explanatory and is also known as the irrevocable letter of credit, ILOC. This is a type of documentary credit which cannot be cancelled or amended, hence the name non-revocable. And these cannot be cancelled by the issuing bank without a proper agreement of the parties of the letter of credit transactions. So, about the non-revocable documentary credit, or also known as the irrevocable letter of credit, the issuing bank cannot cancel or cannot amend unconfirmed irrevocable letter of credits without a proper consent of the beneficiary. Now, the issuing bank cannot cancel or amend a confirmed irrevocable letter of credit without a written consent of the beneficiary and the confirming bank. Hence, there needs to be a consent between the beneficiary and the confirming bank. Now, finally, here are some additional informations regarding the irrevocable letter of credit. So, in conditional payment terms, in order to be getting paid under a letter of credit, irrevocable or revocable, the beneficiary must be a complying representation. In simple words, the beneficiary must make the shipment and collect all trade documents requested under the LC and present and to them to the issuing bank. The nominated bank and confirming bank in some cases do this situation, and the issuing bank will check documents and pay the credit amount to the beneficiary only if the documents are found to be compliant to their agreement. If the issuing bank finds that the documents are non-compliant, then the issuing bank will send an advice or refusal to the beneficiary. But however it is, this is an irrevocable letter of credit. So hence, the situation happens very rarely. Thank you.
Hello everyone, myself Nageshwary, Paramasivan, matrix number 264741. So I will continue my presentation on transferable documentary credit. So first of all, what is a transferable documentary credit? A transferable documentary credit is a type of financial guarantee which known as a letter of credit that allows the first beneficiary to transfer partial or all of the shipment to another party whom the second beneficiary. In other words, it is also known as irrevocable letter of credit. The parties involved in a transferable letter of credit are the applicant, whom the buyer, the first beneficiary, whom the middleman, and the second beneficiary, whom is the seller. Besides, the original transferable letter of credit must allow partial shipment and the second beneficiary is not allowed to transfer further the document. A transferable letter of credit is often used in business trades, especially among the small traders whom are unable to obtain the LC facilities due to their less creditworthiness to ensure the payment to the supplier. A transferable letter of credit is an alternative way to advance their payments. Now, let's go in detail on how transferable letter of credit works. Before proceeding with a customer's order, the seller requires a letter of credit, which is a letter from the bank that guarantees or gives surety on a buyer's payment to the seller will be received on time and for the correct amount. In a transferable letter of credit, the bank will include the provisions for transferring the extensions of credit, whether partial or all of the credit that the buyer was approved to a secondary beneficiary. Then, the secondary beneficiary receives rights to the payment if a loan is needed and the time of payment. However, the first beneficiary is still liable for the payments on the loan if it disbursed by the bank. Okay, now let's look at the features of transferable letter of credit. The first one is it is only transferable for once if partial shipment is not allowed. If partial shipment is allowed, it may transfer to more than one. The second one is the second beneficiary is not allowed to transfer to another beneficiary. The third one will be it transfers according to the terms of original letter of credit except the applicant, amount, shipment date, and the expiry of the letter of credit. The last one is the transferring bank advises the second beneficiary. Moving to the next slide regarding advantages and disadvantages of transferable letter of credit. The first advantage of transferable letter of credit is it is a safe and secure payment method where importers or exporters can safely transact with their foreign traders without knowing them. The second advantage is it provides a better cash flow. The expected payment date and amount to be paid assures the supplier to receive the payment on time. While the disadvantage of transferable letter of credit is strict deadlines, where the seller has to deliver the goods within a given timeline to receive the payment on time. The second disadvantage will be currency fluctuations, where it causes a risk of losing some cash for the related parties. So the seller and the buyer should ensure that the LC uses the same currency to avoid the forex fluctuations. Now let's compare between the transferable letter of credit and the confirmed letter of credit. A transferable letter of credit is more convenient and an easy option for buyers rather than a confirmed letter of credit. This is because the buyer is required to deal with only one bank for a transferable letter of credit, whereas in a confirmed letter of credit, the buyer has to obtain two LCs from two different banks. In order to make the first letter of credit to be confirmed, the second bank guarantees the letter from the first bank. It is required by a seller if the first bank defaults to repay. So that's all for the transferable letter of credit, and now let's focus into the another type of documentary credit, which is the counter trade. Generally, a counter trade is a reciprocal form of international trade where goods and services are exchanged for other goods or services. It is more common type of international trade in such developing countries with limited foreign exchange or credit facilities. Basically, counter trade can be categorized into three groups, which are barter, counter purchase, and offset. In addition, it provides an opportunity to the exporting nation to offer goods and services in a greater international markets as promoting their growth. Let's go into detail on types of counter trades. There are actually many other types of counter trades that importers and exporters use, like buyback, compensation trade, and so on. But these are the main and basic types of counter trades that traders often use. The first one is, as I said, barter. Barter is a direct exchange of goods and services with an equivalent value but not in cash settlements. It is the oldest counter trade arrangements. The second one is counter purchase. Counter purchase is when the exporter or the seller sells the goods or services to an importer with an agreement to purchase goods or services from the importer in future within a specified period of time. The last one is offset, where the seller assists in marketing products manufactured by the buying country or allows the partial exported products assembly to be carried out by the manufacturers in the buying country. Offset mostly involves with larger or expensive items like aerospace. It can be also referred to as industrial participation or industrial cooperation. That's all from me. I'll pass to the next presenter to continue. Thank you.
Hi, my name is TANUSHADEVI RATHAKRISHNA NAIDU, metric number 263359. So now I'm going to continue talking about counter trade. So the first one is advantage of counter trade. So the first one is scarcity and also restrictive foreign exchange reserve. So counter trade is one of the best option for the importing countries. The second advantage will be they are one of the option that find and also enter into new and challenging markets. The third advantage will be businesses has a competitive edge over its competitors. The fourth one is prevention from a bad debt situation. So in case the seller is afraid of a bad debt, they can adapt to this counter trade policy. The fifth one is a better capacity in utilization, and the final one is it facilitates the conservation of foreign currency. Now we will be looking at the disadvantage of a counter trade. Okay, the first one is it accept alternative, which means the payment is instead of hard currency. Okay, the second one is the expenses related to maintaining an in-house trading department to arrange and also manage the counter trade deals. The third disadvantage is the exchange is unusable or poor quality goods which can't be disposed. Okay, the fourth disadvantage, and it is the final one, so which is there are complex negotiations and higher costs, and their logistic issues are more. Okay, now I'm going to explain about the back-to-back letter of credit. So back-to-back letter of credit, it is also referred as the counter LC. So it is used in a situation when a middleman purchases a material under an LC for a resale to the final purchaser. Okay, the middleman does not want to disclose its source to the buyers, so he will be going directly to the source for future purchases. So there are two separate documents credit is involved in this LC, which is one prepared by the middleman bank, and second one is prepared by the buyer's bank. Okay, now we will be looking at the differences between back-to-back LC and also transferable LC. So the first one is for back-to-back LC, it involves two LCs. For transferable, it just involves one LC. So the second point will be for back-to-back LC, they don't need to be designed transferable, and for transferable LC must be designed as a transferable by the issuing bank. The third point is for back-to-back LC, it is issued. There's issues on the responsibility of the bank which they issue second LC. So for transferable, the LC are transferred without any responsible by the bank. So the last point is both for back-to-back LC, both LC are governed by the UCP 600. So UCP 600 is the rules that is agreed by the International Chamber of Commerce. For transferable LC, it is compliant with the Article 38. So in Article 38, it is a definitive statement on the sources of international law. Okay, now we will see the parties that involves in back-to-back letter of credit, which is issuing bank, confirming bank, beneficiary transferring bank, applicant, advising bank, and also accepting bank. So the documents that is used in this back-to-back is invoice, bill of lading, certificate of origin, and also the packing list. Okay, so now we're going to look at the example of back-to-back LC. So, for example, we assume that there's a company A, which is located in US. They sell heavy machineries, and there is a broker B, a trading firm in London, and they found that there's company C, which is located in China, and they want to purchase that heavy machineries. So now they can go through the contract, and so the company A, he's eager to sell the item, but he's afraid that there will be default payment from company C. And also broker B, he wants this trading to go through because he will be receiving the commissions. So what they can do is they can use the back-to-back LC to make sure the transaction goes through. So the company C will go to a well-known financial institution in China and get to issue their LC with broker B as a beneficiary. And then in turn, the broker B, he will be going to he's going to issue the LC at the well-known financial institution in Germany and have the issue on the LC on company A. So the company A now can ship the items, which is the heavy machineries, after once he knows that the transaction have been done, and then paid in the Germany bank. So the broker is also assured that the payment is made and the credit risk has been removed from the transaction.
Hi everyone, my name is KASSWINA, matrix number 261409. Now I'm going to explain about another special type of documentary credit, which is red clause letter of credit and green clause letter of credit. After going through our Facebook posts, I guess you all have some knowledge regarding what is exactly red clause and green clause letter of credit. To make it more clear, now I'm going to explain in details about these both letter of credit. A red clause letter of credit is a specific type of letter of credit in which the buyer can extend the facility of the advance payment to the seller against a certain documentary requirement. Under the red clause letter of credit, the issuing bank will make an advance payment to the exporter, which is the seller, before the seller ships the goods to the importer, which is the buyer. This is usually done to provide aid to the seller in the form of working capital to purchase raw materials, processing and packaging of goods. The advance payments is done against documentary requirement, which includes written undertaking and receipts. Thus, we can say that a red clause letter of credit facilitates pre-shipment finance for the beneficiary. Originally, those letter of credits were written in red ink, so that they are called red clause letter of credit. Moving forward, let us look at the advantages of red clause letter of credit. Firstly, it provides interest-free unsecured working capital finance for the seller. The most defining and major benefit of red clause LC is that the beneficiary, which is the seller, has easy availability of working capital. If the seller avails a regular means of finance, he may have to pay anywhere between 7% to 15% interest for the financing facility. The seller can save on interest expense with the red clause LC. Secondly, advantage to the buyer. When the seller saves interest expense on working capital, he can pass on the benefit to the buyer. Thus, the buyer will have an advantage of lower cost product. This is a competitive advantage for the buyer. Red clause LC creates a win-win situation for both buyer and the seller. Apart from having advantages, there are few disadvantages of red clause letter of credit. Firstly, beneficiary may not use the advance for the right purpose. The main intent of red clause letter of credit is to provide finance to the seller for his working capital needs. This way, he can have enough liquidity to pay for raw materials, production costs, labor, and etc. However, it may happen that the seller will not use the advance payment for its intended purpose. In many cases, it has happened that the seller used the money to pay off his past debt. This actually nullifies the purpose of red clause LC. Secondly, risk of bad debt. In any transaction, when one party gives an advance payment to another party, there is always a risk that the receiver may simply take the money and run off. This risk intensifies when the seller, receiver of the advance, is from another country. The mechanism of the red clause LC is such that the issuing bank extends an advance to the seller on instruction of the buyer. After the seller fulfills its obligation, the buyer pays to the bank. If the seller doesn't oblige to its side of the promise, then the issuing bank will ask for the money it has advanced from the buyer. Thus, it is very important for the buyer to have trust in the seller. Else, this arrangement can actually backfire on the buyer. Thirdly, interest, fees and other expenses. The Red Clause LC is quite an expensive tool. It carries a fixed fee which is higher than the regular letter of credit. Also, the advance payment that issuing banks give to the seller carries an interest rate. At the time of final payment, the buyer has to pay his interest rate plus the letter of credit amount. Therefore, it is necessary that the buyer does a proper cost-benefit analysis before applying for the Red Clause letter of credit. Now let us look at what is Green Clause letter of credit. Green Clause letter of credit is an extension of Red Clause letter of credit, which means it provides the advance not only for the purchase of raw materials, processing and packaging of goods, but also for pre-shipment warehousing at the port of origin insurance expense. In usual cases, the advance under this letter of credit is granted only after the purchased goods are stored in bonded warehouses. This type of letter of credit is usually used in transactions related to commodity market such as wheat, rice, gold, and etc. The documentary requirement for Green Clause letter of credit is more than the Red Clause letter of credit. In addition to written undertaking and receipt, the issuing bank requires documents of title to transfer advance under Green Clause letter of credit. The document of title just proves that the goods to be shipped are already at warehouse. Let us now understand the differences between the Green Clause letter of credit and Red Clause letter of credit. By looking at the diagram below, you all can differentiate between the both LCs. Firstly, what are they? Red Clause letter of credit allows the exporter an advance payment for working capital to purchase raw materials, processing and packaging of goods and etc. In Green Clause LC is an extension of Red Clause. It allows additional advances for the pre-shipment warehousing at port of origin and insurance expenses apart from covered in Red Clause. When advances is given. In Red Clause, bank will make an advance payment to the exporter before the seller ships the goods. In Green Clause, in usual cases, the advance is granted only after the purchased goods are stored in bonded warehouses. Okay, for Red Clause, the document required are written undertakings and receipts. In Green Clause, additional document is required apart from written undertaking receipts. Proportion of advance. In Red Clause letter of credit, usually the percentage of advance available is 20% to 25% of the face value of the letter of credit. In contrast, the availability of advance can be expanded to 75% to 80% of the face value of the LC under the Green Clause LC. In the aspect of security, in such international transaction, the buyer is always concerned about his safety as he is paying advance money to the seller. The buyer, which is the importer, is more secured in Green Clause LC than the Red Clause LC. This is because the buyer is extending the advance against the document of title, which means the buyer knows that the goods in question are already warehoused and only the shipment procedure is remaining. On the other hand, in the Red Clause LC, the advance can be extended even before the production begins. This makes it more risky for the buyer.
Hi everyone, I'm RUBBINI, daughter of MUNIANDY, metric number 262088. So now let's move on to the other type of LC that has been used commonly in international trade and finance, which is standby letter of credit. SLC refers to a legal document where a bank guarantees the payment of a specific amount of money to a seller if the buyer defaults of the payment agreement. It is more or like a bank guarantee, but it is not a bank guarantee. SLC acts as a safety net for the payment of a physical shipment of goods or completed services to their seller. In the event something unforeseen prevents the buyer from making the scheduled payments to the seller. In such a case, the SLC ensures the required payments are made to the seller after the fulfillment of the required obligations on time. A standby letter of credit is used in an international trade or domestic transactions as well, where the seller and buyer do not know each other very well. They do not have any existing previous relationship between each other. So SLC, it attempts to hedge out the risk associated with such a transaction. Some of the risk might be included bankruptcy of the importer, means the buyer, and insufficient cash flows to the seller on time. So in case of an adverse event, the bank promises to make the required payment to the seller as long as they meet the requirements of the standby letter of credit. What are they? What have they been written in the standard SLC? So the bank payment to the seller is a form of credit, and the customer buyer is responsible for paying the principal plus interest as agreed with the bank. Now let's look on to the process of SLC on how it works out on an international trade. Since the parties to the contract do not know each other very well, as I have mentioned earlier, the latter promotes the seller's confidence in the transaction. So it is seen as a sign of good faith since it allows the buyer's credit quality and ability to make payment for goods and services provided if an unforeseen event occurs. When setting up an SLC, the buyer's bank performs an underwriting due to verify the credit quality of the buyer. Once the buyer's bank is satisfied that the buyer is in good credit standing, then the bank will proceed to send a notification to the seller's bank, assuring its commitment of payment to the seller if the buyer defaults on the agreement. It provides the proof of the buyer's ability to make payment to the seller. As we can observe clearly, the process of letter of credit, usual letter of credit and also a standby letter of credit are similar, in which the issuing bank will act on behalf of the importer to issue a SLC, but there are also some key differences in both LC and SLC that we need to take note of it. So first, we look at backup plan. An SLC is a safety net. Like most safety nets, the goal is to avoid using it. So when somebody gets paid with an LC, means something has been occurred, means something is wrong. So with a standard letter of credit on the other end, everybody involved hopes and expects that payment will occur no matter what the situation is. For example, those letters pays when an exporter successfully delivers a shipment to an importer. Second, purpose. An SLC is paid when called on after conditions are not being fulfilled. However, a letter of credit is the guarantee of payment when certain specifications are met and documents received from the selling party are good, no problem with it. Third, the requirement of features or any types of clauses. An SLC that might have specific clauses that the buyer must fulfill to be able to use this scheme. Whereas in an LC, it does not have any specific clauses or features that the buyer needs to fulfill. Fourth, the need for collateral. A SLC calls for an obligation for the bank, and so the bank will need some collateral in the form of security. By the way, for issuing a letter of credit, the bank analyzes the buyer's credibility and credit score to determine their creditworthiness of the payment in the future. Number 5, we'll look on to the performance aspect. And SLC are also unique because they can include a performance component or negative performance if you prefer. If a service is not performed, then the beneficiary gets paid, as we know. Sixth place, SLCs are used frequently for domestic transactions. Those might include everything from building projects to receiving electricity services. Commercial letters, on the other hand, are more common in an international trade. Period. A standby letter of credit is a long-term instrument in which the validity is usually from 6 months to 1 year or so on. The last one is cost. An SLC is far more expensive than a usual LC. The fees of an LC range from 0.75% to 1.50% of the covered amount. Also, the bank can charge anywhere from 1% to 10% to cover the same amount under a standby letter of credit. Next, we'll look at the types of standby letters of credit, which will be focusing mainly on two, which are financial SLC and performance SLC. A financial based SLC guarantees payment for goods or services as stipulated in the agreement. For example, if a crude oil ships oil to a foreign buyer with an expectation that the buyer will pay within 10 days from the date of the shipment and the payment is not made by the required date, then the crude oil seller can collect the payment of goods from the buyer's bank, commonly issuing bank. So since it is a credit, the bank will collect the principal plus interest from the buyer no matter what. Second, performance SLC. A performance-based SLC guarantees the completion of project within the scheduled timelines. If the bank's client is unable to complete the project outlined in the contract, then the bank promises to reimburse back the third party to a contract when a specific sum of money is not being paid. So performance SLC are used in projects that are scheduled for completion within a specific timeline, and such as construction projects mainly. And it is used to compensate the customer for the inconvenience cost or pay another contractor to take over the project if there are delays in the project's completion. Next, advantages of SLC. An SLC helps ensure that the buyer will receive the goods or services that outline in the document, and also the buyer has an increased certainty that the goods will be delivered from the seller on time. Second, the advantages for the seller is that SLC reduces the risk of the production order being changed or cancelled by the buyer. So in conclusion, to summarize all, as mentioned above, a letter of credit can be of various types of depending on its purpose. So there is no best option or focusing specifically only on one types of LC that is effective. Basically, it is in the interest of both the buyer and the seller to understand all different types of thoroughly and pick one which serves the purpose completely. So we really hope that we have covered everything fully and also help you all to gain some knowledge on the types of LC used in an international trade and finance. Thank you.